Nikesha, you could not log in at all last week. Why? So in the future, if you have a technical issue for logging in, you need to contact me by email. So I can check my email. I frequently check my email. And so if there is a technical issue, you need to let me know. You need to contact me immediately, okay? All right, so let's get started. So you're learning capital budgeting issues. Okay, I see another movement in the chat box. No, we don't have a class. I don't cancel a class. I saw it there. So don't assume anything. If you have any questions, you should contact me by email. Okay. All right. So in chapter 9, you learn capital budgeting tools. So you learn the net present value, internal rate of return, payback rule, discounted payback rule, and average accounting return. So we only have one more remaining, profitability index. So we are gonna, you're gonna learn it soon. But before we move on, right now we are comparing NPV with IRR. So NPV is the most reliable and capital budgeting tool. But the second most popular and useful tool is IRR, internal rate of return. But there are two important situations where IRR is not reliable. So we are learning that those kind of cases. So in what kind of situations NPV and IRR provide different suggestions. So you remember in capital budgeting decisions, the most important information these tools provide is whether to accept the new project or reject the new project. So in two cases, IRR and NPV are make different suggestions. So what are those two situations? First, when projects have a non-conventional cash flow, IRR can be problematic. By non-conventional cash flow, I mean cash flow just change signs more than once, or initial cash flow is positive and future cash flows are negative. In other words, so what do we mean by conventional cash flows? So conventional cash flow projects mean initial cash outflow. So companies make an investment initially, and later there is a cash inflow. So in that kind of a conventional cash flow problems, IRR calculation is straightforward. But if there is a non-conventional cash flow project, IRR, there are more than one. There is more than one IRR. So this slide shows that kind of example. So the previous, so this is an example of a non-conventional cash flow. Initial cost negative 90,000, but year 1, year 2 positive, but year 3 cash flow is negative. So cash flow change signs, the cash flow change signs more than once. So in this case, twice. So when we plot this project NPV by changing the required return, usually if there is a if we are looking at a conventional cash flow project, how does this NPV discount rate diagram look like? It's just monotonic decrease. So this kind of discount rate and present value inversely related. So that's a conventional cash flow project NPV profile. But in this project, we see NPV increase with the discount rate and decrease with the discount rate because this project has a non-conventional cash flow, which changes sign twice. So that's why there are two IRRs. So what was the definition of IRR? The discount rate that makes the NPV of the project equal to 0. So because this project has non-conventional cash flows, there are two discount rates that makes NPV equal to 0. So there are two IRRs. So which one is relevant? It's not clear. So in short, what I'm trying to say is if the project you're looking at has non-conventional cash flows, do not use IRR. So especially in that kind of cases, IRR will not work. So always, it's safe to use NPV always. Yeah. So this is the summary. So NPV use always for use NPV and accept the project if NPV is positive at the required return. If NPV is negative, reject the project. Okay. The second case of IRR becoming problematic is when we are evaluating mutually exclusive projects. So mutually exclusive projects mean that we cannot accept two projects. So if one project is accepted, the other should be rejected because it's not possible for accepting both. So I'm not saying that that's always the case, but specific there is when corporations evaluate new projects, sometimes there are competing projects. So if A is accepted, B should be rejected. It's not possible for a company to accept both. In that kind of situation, we call those projects mutually exclusive. So when we are evaluating mutually exclusive projects, IRR does not work. So you should use NPV. So here is an example. We are evaluating two projects, project A and B. And initial investment for project A is 500. Project B, 400 initial investment. And here are year 1 and year 2 cash flows. So you should be able to calculate IRR and NPV of these projects. So how? In this simple example, just you can use it for NPV calculation. For example, you can discount 325 using required return of 10%. So that means 325 divided by 1 plus 10% to the power of 1 plus 325 divided by 1 plus 10% to the power of 2. So those are the present value minus 500. So that's 64.5. Or you can use the NPV function of Excel and then to find the present value and subtract 500, you get the same answer. Similarly, you can calculate the IRR using the IRR function of Excel. So to do the calculation. So let me emphasize once more, doing NPV and IRR calculation is not difficult, but if you don't practice, you will have you will have difficulties. So that's why I give you connect homework. And I see several students completed it. So if you did, if you are one of those, yeah, thank you and keep up the good work. But if you haven't finished the Connect homework, it's due by Wednesday. So you must practice and complete. Yeah, don't lose points because of the late penalty. So meet the deadline and complete the homework, Connect homework assignment. All right, so you calculate IRR and NPV, yeah, and so here is the answer. So you should be able to, again, let me emphasize once more. You should be able to calculate NPV and IRR for these, when using these cash flows, provided cash flows. So if these two projects are not mutually exclusive, meaning that if these two projects decisions are independent, what should be done for these projects? So if these two projects, first let's start with project A. Should we accept this project or reject this project if this is an independent project? We should accept it. Why? NPV is positive. How about project B? If project B is an independent project, it accepted or rejected independent of other projects, if we just take a look at the project B, if it's an independent project, should we accept project B or reject project B? We should accept project B. Why? Because NPV is positive. But these two projects are mutually exclusive. So if that's the case, if project A and project B are mutually exclusive, meaning that if one is accepted, the other should be rejected. So if that's the case, which project should be accepted? So let me, yeah, anyone write it. So in this case, when project A and B are mutually exclusive, we should accept project A, not B, and B should be rejected. Why? Because project A has a higher NPV. So NPV is higher for project A than project B. That's why project A is accepted, but project B is rejected. But some people might argue that, oh, project B has a higher IRR than project A. Why accept this project B that has a higher internal rate of return than project A? Because when NPV and IRR are giving conflicting results, we should use NPV. Yeah, so that's what this mutually exclusive project example teaches you. So any questions so far? No? Okay, good. Then let's take a look at this project A and project B's NPV and discount rate chart. So the discount rate goes up, present value goes down monotonically, because this is both are conventional cash flow projects. So there is a monotonic decrease of NPV when the discount rate increases, and there is a crossover point of these two projects, 11.8%. And the and the discount rate is less than 11.8%, project A has a higher NPV, and if the discount rate is higher, A's NPV is lower, but the required return is 10%. So that's why in that kind of situation, project A is accepted and project B is rejected. So in short, non-conventional cash flow projects and mutually exclusive projects, in those cases, NPV and IRR may provide different suggestions. In that case, follow NPV. So always use NPV. So that's the lesson these examples are teaching you. Any questions so far? No? And then let's proceed. So we move on to the last capital budgeting tool, Profitability Index. So Profitability Index measures the benefit, the value per unit cost based on the time value of money. So the definition of Profitability Index is the present value of all future cash flows divided by initial cost. So in other words, for each dollar invested now, how much is the value generated? So how do you calculate the present of future cash flows? You can calculate the present value of future cash flows individually, or you can use the NPV, calculate the NPV and add back initial cost divided by initial cost. So that's the profitability index. So if we are looking at a project that has a profitability index of 1.1, that means for each dollar of initial investment, $1.10 of benefit value is generated. So in other words, 10 cents per dollar is the added value. So what should be the decision rule for profitability index? So if a project has a profitability index greater than 1, accept the project. Less than 1, reject the project. So that's the rule. So positive NPV project, and so let me let me ask you a question. Yeah, let me stop share and launch a poll. Okay. True or false? Yeah, let me ask you a true or false question. The question is, positive NPV project, NPV and PI always if a project is accepted, if a project is accepted by the NPV rule, it always accepted by PI rule. It is always accepted. It does not work right. So it's, I think, yeah, I will cancel the poll. So I'll just explain it. It's not a good idea. Let me go back. Yeah. What I'm trying to explain here is, so what's the rule for NPV? So what's the rule we apply when we use NPV for capital budgeting? So if NPV is positive, accept the project. And NPV is negative, reject the project. Why? Because the positive NPV means that the positive value measured by NPV is generated by the new project. So because value is generated, we accept the project. So again, positive NPV projects are accepted. Similarly, what kind of projects are accepted by PI? If PI is greater than 1, accept the project. If PI is less than 1, reject the project. So what I was trying to ask you was, does the NPV rule and the PI rule always provide the same answer? The answer is yes. So why? Positive NPV is always meaning PI greater than 1. So NPV and PI are always giving us the same answer. So that was the poll question I was trying to ask you. So that's a true statement. NPV and PI give us the same answer. But you may wonder, then why do we calculate PI? We just calculate NPV, that's it, right? Because PI and NPV provide always the same answer, but why do we bother calculating another capital budgeting measure, PI? There is a good reason for calculating PI. So you should remember, PI calculation is very useful when there is a capital rationing issue. So what do I mean by capital rationing? Capital rationing means that capital rationing is a term used in corporate finance, in a more advanced corporate finance discussions, where the capital available for a corporation is limited. So if there is a limited, so theoretically, if there is a positive NPV project, the companies should be able to finance the project and invest in the project because that project adds value after considering the riskiness of the capital. But in the real world, there is information asymmetry, meaning that even though corporate managers know that the proposed project will generate value for the corporation, so after the investment, the value of the corporation will go up. But remember, we are looking at risky projects. So by definition, all those investments are risky. So meaning that on average, and then positive NPV projects will generate value, but there is no guarantee. If something really bad happens, then the project will not generate value. So for example, if a cruise liner was expanding, so there was a boom, like actually 2-3 years ago, the cruise industry was growing very rapidly. A lot of people wanted to have an experience in exotic areas. So cruise trips demand was growing fast. So all the trips, cruise liners planned and sold, the reservation rate was very high. So cruise liners, and it takes many years to build a large cruise ship. So imagine a cruise liner 2 years ago, they had many projects to build a new cruise line, and they raised the capital and they did the calculation, positive NPV project. But what happened? During the COVID-19 pandemic, so cruise lines, their business is struggling. So what I mean is, 2 years ago, the positive NPV project cruise liners planned. At that time, there was a positive NPV project, but there was a new information arriving at the market, the pandemic. So that positive NPV project ended up making cruise lining companies lose a lot of value. So all those capital budgeting projects we are evaluating, so this is about risky investment. So there is no guarantee. So when companies propose positive NPV projects and try to raise capital to actually invest in the project, investors, Wall Street analysts, and other investors may not be convinced about the outcomes. So when companies bring 5, 10 projects to the market and show to the investors and try to raise capital, there may not be enough capital to fund all those positive NPV projects. So in that kind of situation, we call companies have limited capital. So this is called capital rationing situation. If that's the case, so companies, especially young companies, startups, and small companies, just started with great ideas, but still not generating a lot of profits. Early days of Facebook, for example. And another example, Tesla. Tesla is now a good large company. Stock prices are booming and going up, but still Tesla is not as stable as Amazon, that kind of companies. So still rapidly growing companies may have some shortage of capital. It may be difficult to convince investors to make them invest large capital in their new positive NPV projects. So if that's the situation, what kind of capital budgeting tool helps making decisions on which project should be funded? In that case, use profitability index. So list all the projects with profitability index greater than 1, meaning that every $1, more than $1 value is generated. So profitability index greater than 1, that kind of project, list them in the order of profitability index, decreasing order of profitability index. Then go from top until all the capital is exhausted for the initial investment. So in that case, which one, when capital is limited, which project should be funded first? Project with a higher profitability index will be funded. So the next slide shows an example. So we are looking at the same project, same numerical example, how to calculate profitability index. So for each cash flow 1, 2, 3, how to find the present value by discounting using 12% required return. So find this present value of future cash flows divided by initial investment, 165,000, and the profitability index is 1.08. So for each dollar, $1.08 is the generated value. So additional value added is 8 cents per dollar. So what's the what are the advantages and disadvantages of PI? So advantages are PI is very closely related to NPV. So PI and NPV lead to identical decisions. And it's easy, PI is easy to understand, and how to explaining what PI means is very straightforward and intuitive. So you can communicate using this PI number with those who don't major in finance. So it's very intuitive. So very useful when available capital is limited. But the problem, disadvantage is PI may lead to incorrect decisions in mutually exclusive investments. So mutually exclusive investments, it's similar to IRR. PI may not work for mutually exclusive projects. So the conclusion is always use NPV is your primary tool of capital budgeting. So in the real world, when you consider several investment, when you make capital budgeting decisions, it's good to use several tools to compare. And the most widely used tools are NPV and IRR. But for simple projects, payback rule is also widely used. So that's all I have for this chapter. So any questions? Again, the most important knowledge and skills you should gain from chapter 9 is when you are given a project, numbers, you should be able to calculate NPV, IRR, PI, payback, discounted payback, and average accounting return. You should be able to calculate those. So that is the most important skill you should gain from this chapter. So if you have a difficulty in there, you will have a lot of difficulty in the final exam and the next quiz. So any questions on this chapter? So if you don't have any, so I see a movement in the chat box. Okay, so it looks like no one has a question. Then let's move on to the next chapter, chapter 10. Okay. In chapter 10, you are learning how to apply the tools you learned in the previous chapter. And we are using more interesting examples. So chapter 10 is actually quite complicated because here, unlike the previous chapter, where I give you the input for NPV calculation. But here in chapter 10, I will often ask you to calculate cash flows on your own to do the NPV calculation. Oh, so it's more challenging, chapter 10. So how do you calculate cash flows on your own? You use your chapter 2 knowledge. So in chapter 2, you learned how to calculate cash flow from assets, right? Where did you start? Oh, you calculated operating cash flows. And then you made adjustments using capital spending and net working capital. So change in networking, change in net capital spending and change in net working capital. So those should be subtracted from operating cash flow to calculate cash flow from assets, right? So you need to do that kind of calculations here in chapter 10 before you do the NPV calculation. So that's why chapter 10 is more complicated, because you are combining chapter 2 knowledge and chapter 9 knowledge to learn something more closer to the real world situation. So in other words, if your knowledge in chapter 9 is shaking, chapter 10 will be really difficult for you. Similarly, if you don't remember chapter 2 cash flow calculation and have a lot of difficulty, you are gonna have a lot of more difficulty in chapter 10. So if your understanding of previous chapters is shaky, later chapters will become more challenging. So my point is, don't make problems accumulate. So make sure each chapter you understand the core concepts clearly, and then build on those fundamentals, foundations. And especially finance and accounting majors who will take next level finance courses. In this finance 3310, what you learn in finance 3310, I used to say that this finance 3310 is like learning ABC in finance. So it's a core. The tools, the NPV tool, for example, you learned in the previous chapter and this chapter, it will come back in finance 3311 and finance 3330 investment. So if your fundamental in this principles of financial management class is shaking, you will have difficulty not just in later chapters of this class, but also all those future finance classes you need to take, you will have difficulty. So don't make that happen. But this course is not too difficult. So, and I try to make what your responsibility is manageable. So follow me carefully, don't get lost, and that's the most important thing. Then you will be okay. So small steps, but don't miss the path. So follow me closely and ask questions if anything is not clear. So, all right. So chapter 10 is about making capital investment decisions. So you build on what you learned in chapter 2 and chapter 9. So the most important concept I would say you need to learn in this chapter 9 is the concept of incremental cash flows. So here you need to calculate cash flows to be used for an NPV calculation. But you are not just calculating cash flows, you need to calculate incremental cash flows. So in other words, the change. So when we evaluate a new project, and I can give you a simple example. Suppose you're evaluating a new project of building a parking lot. So the parking lot should be built near the Times Square or not. So that if that's the project you're evaluating using NPV, the parking lot, new parking lot near Times Square. So parking garage, so building a parking garage. But the building, so when we calculate cash flows for the new parking garage project, what if? And the parking, the space, the land, your company already owns. So that means the land you don't have to purchase. So it's not a cash outflow. But should we include the price of the land when we calculate the cash flows for the new parking garage project? The answer is definitely yes. Why? If we don't use that land for the parking garage project, the land can be sold for other purposes and generate cash. So even if that's the cash, not the cash outflow, payment for the land was already made a long time ago, but still that the price of the land should be included for the evaluation of the NPV of the new parking garage project. So it's not just merely cash outflow, inflow. It's not just about the project itself, just the incremental cash flows concept. Another example is, what if the new parking garage, if your company already owns another parking garage nearby, in addition to this new parking garage, new project, if the new garage is built, the nearby garage's cash flow will be reduced because of the competitive nature of those two buildings, parking garage buildings. Then, when you evaluate the NPV of the new parking garage project, you should consider the decrease in cash flows in your existing business should be considered. Similarly, if the new parking garage, what if your company owns a restaurant nearby? And if there is another parking garage, your restaurant business will attract more customers and the cash flow will go up. Then that positive side effect should also be considered when you calculate the cash flows from the parking garage project. So positive side effect, negative side effect, sunk cost, and others impact. So when you calculate cash flows, the mechanics you borrow from chapter 2 knowledge, but you add here in chapter 10, that incremental cash flow concept. So that's the most important concept, but it will become clearer. You may have some kind of idea right now, but you may not understand the details at the beginning, but that's okay. We are going to have a lot of examples down the road, so don't worry. But just as a starter, you should keep them, cash flow calculations and cash, what to be included, what not to be included, that may, you need to pay attention. So that kind of impression right now, that's enough. So to calculate cash flows for a new project, definitely you need financial statements. But by definition, we are evaluating a new project, so we don't have financial statements yet because it's a new project. But we can prepare pro forma financial statements using estimated revenues and estimated costs. So we need to prepare pro forma financial statements, but don't worry too much because this is an intro class. I'm not going to ask you to prepare the detailed pro forma financial statements. That kind of a complicated task. If you want to work for investment banks, that's what they do all the time. But in this intro class, I will give you most of the information, but just to ask you to feel a bit of blank or use those information to do some analysis. So I'll try to make your task manageable, but still you need to learn. You need to be prepared to learn more complicated concepts, but because by definition, here you're learning how corporations make investment decisions. So the task is quite a complicated task. And in chapter 10, you are exposed to many of those advanced materials. Yeah, so be prepared to learn those advanced issues. Another important issue you need to learn here is depreciation tax shields. So when you calculate cash flows, you should keep in mind depreciation is not an actual cash outflow, but depreciation has tax implications. So you should learn how to consider depreciation tax shields when you calculate cash flows. Also, salvage value. So salvage value means at the end of the project, when there is an equipment and physical assets remain, that those used equipment can be sold and generate cash flows, and how to consider those cash flows from used equipment to evaluate cash flows for a new project. So that's called after-tax salvage. So, and that's, you need to compare market value of the used equipment and book value of the used equipment. So for the difference, pay tax, and after tax, how much is the cash generated from the sales of the used equipment? That part should be considered as well in the cash flow estimation of a new project. So those are the important concepts. So this slide is explaining incremental cash flows concept. So before you calculate NPV, you should gather information, collect information to calculate the initial investment as well as future cash flows. So to get a good estimate of NPV, your input. So NPV, the net present value, is the output of your calculation. If inputs of NPV calculation are not in good quality, you cannot get a good NPV estimate. So garbage in, garbage out. So you should make sure your cash flows you use for the NPV calculation are in good quality. So when you evaluate cash flows, you should always ask this question. Cash flows should be included in a capital budgeting analysis. What are those? What kind of cash flows we should include? The answer is the cash flows you include in the NPV calculation are those that only occur if the project is accepted. So if this project is accepted, there will be this cash inflow or cash outflow. So that's the rule. So if nothing changes, whether this project is accepted or rejected, then those cash flows are not relevant. So that concept is called, those cash flows are called incremental cash flows. Yeah. And this standalone principle allows us to analyze each project in isolation from the firm. And so there are many examples. So this is when we need to use the incremental cash flow concept and the standalone principle. So you should ask the right question. So will this cash flow change only if we accept the project? If the answer is yes, include it. So if the answer is yes, you should include that cash flow. If the answer is no, do not include it. And sometimes situations may be more complicated. The answer may be part of. If that's the case, part of those that change by the project should be included. So far you may wonder, you may have a vague understanding of, okay, cash flow calculation for a capital budgeting problem may become complicated. How? What are the examples? So incremental cash flows, that concept sounds like complicated. So what are some examples of the situations where we need to be more careful? So this slide is very important because it gives you some situations, examples where the incremental cash flow concept should be very carefully examined. So the first example, sunk costs. So the costs that have already occurred. So sunk costs, like going back to this parking lot example. So new parking garage project requires the land. You will use the land that was purchased 10 years ago for $10 million. So the $10 million is the sunk cost. So that $10 million will not appear as the cost, even though it was paid for the land. The $10 million was paid 10 years ago, but that $10 million will not enter as a cash outflow to this new parking garage project. Why not? It's a sunk cost. It already was paid 10 years ago. So whether the parking garage new project will be accepted or rejected, it's not. The 10 million purchase price paid 10 years ago does not change. So it's a sunk cost. But I don't mean the value of the land should be ignored. So that's why the next concept is so important. Opportunity cost. So cost of lost options. So ignore sunk cost, but you should include opportunity costs. So going back to that parking garage example, so the $10 million paid 10 years ago, that's a sunk cost, so should not be included. But what if the land 10 years later, now the value is $24 million? So then the $24 million of the value of the land should be used as a cost. Because if 24 million, the land is not occupied by the parking garage, the $24 million can be generated by selling that land at the market price. So that's the opportunity cost. If the land is used for a new parking garage building, the opportunity cost, the $24 million of the land will be used, so that can be sold otherwise. So that's the opportunity cost example. So cost of lost options, opportunity cost should be included in the capital budgeting decision, NPV calculation. And similarly, side effects. There can be positive side effects, so benefits to other projects. An example I used was if there is a restaurant the company is running nearby, and if there will be a sales increase because of the readily available parking, that positive side effect, that will be considered as a positive cash flow. So because that positive side effect, if it's ignored, we may not accurately calculate the value the new parking garage projects generate for the company. So that's why positive side effects should be considered. And similarly, the new project may have a negative side effect. So the cost to other project, that should be considered as well. And similarly, in the parking garage example, if the company has another parking garage down nearby, and that parking garage have a negative impact because of the newly built parking garage, then that negative side effect also should be considered in the cash flow calculation as well as NPV to make the best decision for the company. Also, when there is a net working capital changes, that should be considered as well. So you remember, when we calculate cash flow from assets, we start from operating cash flow, and we made an adjustment for capital spending and net working capital change. And also financing cost, you should also consider, as well as tax. There are tax issues. So to calculate cash flows for capital budgeting projects, we start with a financial statement, pro forma financial statement. And this slide just to remind you of the equations you learned. So to calculate cash flow from assets, where do we start? Income statement. To find what? EBIT. So EBIT plus depreciation minus tax is operating cash flows. So you calculate operating cash flows using income statement information starting from EBIT. And then, but operating cash flows are not equal to cash flow from assets. So how do we convert operating cash flows to cash flow from assets? We subtract net capital spending and change in net working capital. How do we find net capital spending? Net capital spending is ending fixed asset minus beginning fixed asset plus the depreciation. So those information are from the balance sheet, pro forma balance sheet. How do we calculate change in net working capital? So what's the definition of net working capital? Current asset minus current liability is the net working capital. So ending current asset minus ending current liability. So that's the net working capital at the end, minus beginning current asset minus beginning current liability. That's the beginning net working capital. So ending net working capital minus beginning net working capital, that's the change in net working capital. So you subtract that change in net working capital from OCF and net working capital spending, and that's cash flow from asset. So these equations, those equations are nothing new, just a reminder from chapter 2. So any questions so far? So if you don't have any questions, yeah. So before we move on, let me take a screenshot. So just to, yeah, let me take a screenshot for attendance. Okay, I took the first screenshot and then move on to the next slide, next screenshot. The second page, I took the screenshots, and just in case I need it, I also copy the chat box information. Okay, and then I save it. Okay, I took the attendance, and then let me go back to the slides. So let's use a numerical example. Yeah, so here is a 3-year project. And here is a very simplified version of the income statement, pro forma income statement. So initially for this project, it requires initial investment of $90,000 in equipment and $20,000 in net working capital. And the new project will generate incremental sales of 50,000 units, and the price of each unit is estimated to be $4. So estimated revenue, sales revenue is $20,000. And what are the costs of that product? So 50,000 units, how much does it cost to make those units, 50,000 units? So suppose you estimate that variable cost will be $2.50 per unit. So meaning that the total variable cost will be $125,000. So that gross profit is $75,000, but there are fixed costs. So whether the production is made or not, so like variable costs are like cost of raw materials, like cost of goods sold. But there are also fixed costs, whether the production was made or not. There may be some fixed costs like office or something like that, or employees' wage. Yeah. For hourly workers, that it will be variable cost, but there are some others whose salary will be paid whether production is made or not. So there are fixed costs of 17,430. So that's the estimate. And also 90,000 initial investment will be depreciated for straight line for 3 years. So annual depreciation charge is 30,000. So EBIT is 27,570, and the tax rate is suppose 21%, and then you subtract the tax, and suppose there is no interest payment. This is fully funded by equity, that no bond or bank debt. So that's the case. You just subtract tax, you get a net income of 21,780. So if I give you this pro forma income statement, if I ask you to calculate operating cash flow, what are you going to do? Is it too difficult? So to calculate operating cash flow from this information? No, it should be very straightforward, right? So when we have an income statement, we can calculate operating cash flow. How? EBIT plus depreciation minus tax. So that's how to calculate operating cash flow. So EBIT plus depreciation minus tax. So so in other words, so this is it. When you are given just this slide, you should be able to calculate the cash flows, year 0, year 1, and year 2, and year 3. So in other words, you should be able to fill out this blank. So can you make this kind of table using just the information in this slide? You learned everything to do the calculation, but if you don't practice and just need to take a quiz or an exam, you will have a lot of difficulty. So my suggestion is take a moment without looking at my answers in the next slide. Think. This is a 3-year project. So year 0 cash flow from asset, year 1 cash flow from asset, year 2 cash flow from asset, year 3 cash flow from asset. So you need to find 4 numbers. Cash flow is 0, 4 numbers. Cash flow 0, cash flow 1, 2, 3. So those 4 cash flows you need to find. How? Let's start year 0. So what's the year 0 cash flow based on this information? Oh, year 0 cash flow is easy. 90,000 capital spending. So buying equipment. So capital spending, and 20,000 net working capital investment. So 11,000 outflow. So that's here. So 1,100,000 cash outflow. So cash flow is 0. Then how do you find cash flow 1, 2, 3? Again, so remember, cash flow from assets you are calculating has 3 components: operating cash flow minus net capital spending minus change in net working capital. So year 0, there is no operation. So year 0 means right now you make an investment, and after 1 year there is a sales and production. So operating cash flow occurs 1, 2, 3 years. So 3 years. So how do we calculate 51,000 this operating cash flow? We use the information, the equation: EBIT plus depreciation minus tax, using the pro forma income statement you have in the previous slide. So 51,780. So that's one method. Or you may want to go backward from net income. So net income, and you add back depreciation and interest payment. But in this example, there is no interest payment. So you just add back depreciation, because depreciation is not a cash outflow. So so either way, but I would recommend using this EBIT plus depreciation minus tax. Yeah. So 51,780. So that's operating cash flow for 3 years, not year 0. So there is no time for production and sales at time 0. It's now. But so what's the equation for cash flow from assets, starting from operating cash flow? OCF, operating cash flow, minus change in net working capital and change in and net capital spending. So at year 0, 90,000 of capital spending, cash outflow, and 20,000 of net working capital. But what happens to this 90,000? There is no mention of salvage value or anything. So we assume this 90,000 equipment will be used and there will be no value at the end. If there is a value and explanation about that there, we are going to consider it here, but there is no information about the value of the used equipment, so we will just ignore. But what about $20,000 working capital change. So to do the business, working capital 20,000 was needed at the beginning. But what happened at the end? Working capital will be returned. So that means there is a inverse. So cash outflow of 20,000 for net working capital will be gained, will be returned to the so those net working capital will be recovered at the end. So 20,000 cash inflow, you should consider that. And operating cash flow, year 1, 2, 3, the same. So that's how year 0 cash flow, year 1 and 2 cash flows are just operating cash flows, but year 3 cash flows are operating cash flow plus returned net working capital of $20,000. So you have cash flows, year 0, 1, 2, 3. And calculating NPV should be easy. So if the discount rate is, the required return is 20%, NPV is $10,648. So if you click this Excel file, you can see how to use Excel to do the calculation, but you already learned it, how to do it in the previous chapter. So my recommendation is don't look at my answer and just do the calculation and make sure you are able to calculate the NPV of 10,648 and IRR of 25.8%. So should we accept this project or reject this project? We should accept this project. Why? Because NPV is positive. So this project will generate, add $10,648 to the company. So definitely we need to accept this positive NPV project. So this is an example of how to use a pro forma financial statement to calculate NPV. Any questions so far? So we have only 2 minutes, so I'll just quickly show you what's remaining. So net working capital issues, another, so we will spend some time to talk about net working capital. So we will also talk, you will also learn there is another way to calculate operating cash flow. It's a tax shield approach. So start from sales revenue, subtract all costs, multiply by 1 minus tax rate plus depreciation, multiply by tax. So this is another way to calculate operating cash flow quickly. So either way, EBIT plus depreciation minus tax, or this equation gives you the same answer. But sometimes this equation, using this equation, is much faster in the terms of calculation. So, and also intuitive about the tax shield impact, tax impact. So you're gonna learn this. And depreciation, we have also after tax salvage example. So this is a more comprehensive example. So, and my recommendation is using this just slide and can you calculate NPV? So without looking at my answers. So we are gonna use these numerical examples. So this chapter is short and we will quickly finish it on Wednesday and move on to the next chapter. So this is the end of today's class. So I will see you Wednesday. And don't forget about the Connect homework. So complete the homework. So if you don't have any questions, I'll see you Wednesday. Bye. And if you have a question, unmute and speak or write your question on the chat box. Yeah, thank you. Bye. So let me stop share. So if you don't, yeah, have a good day. Bye.